Rooted Wealth Advisors is not your typical wealth management firm. They are not afraid to roll up their sleeves and work hard to help build the best version of the rest of your life alongside of you. Here today, sponsoring our segment from Rooted Wealth Advisors, is John Samarino. Welcome back to ciLiving.
Jaclyn, super excited to be here with you.
So tell me a little bit about Rooted Wealth Advisors.
Yeah, so Rooted Wealth Advisors is a local financial planning and wealth advisory firm, local here in Champaign, Illinois. Specifically, we're helping, ultimately clients or potential clients that are near retirement or already in retirement.
Okay, and I know that there are different ways to invest depending on where you are in your life. I see that you have brought some visual aids today and they look delicious, so tell me a little bit about what's going on this table.
All right, so we actually have some props today. I got tired of all my friends and clients teasing me about not having props, so we're gonna make our investments fun today.
And delicious.
And delicious. So specifically when it comes to the risk of our investments, and we're gonna look at it from a very fundamental perspective.
Okay.
For those that wanna get into the weeds of all the metrics and specifics, we can do that. But for today, let's keep it fundamental. So ultimately, we're just categorizing risk with these cookie jars and saying our opportunistic growth, right, our fullest cookie jar currently is going to be the most aggressive, right? That's where we want to hit the home runs. But we might strike out a year or two. Overall, though, as long as we allow that cookie jar enough time, it's going to grow the most.
And so do you want to put the most money into this cookie jar if you're dividing it into different ways, or does it matter where you are in your life, or when would I want this cookie jar to look this full?
Great question. The younger you are, the more time you have before we need to start eating those cookies, then we want more there, right?
Okay.
Now, as time starts to decrease, right? Let's say that we are 10 years or less with regard to needing some of those cookies, we probably want to start to shift those over into these other cookie jars. But I would say for anyone that's under 40, and as long as they have the tolerance, that's where they want their cookies.
And when you say tolerance, you're talking about risk tolerance of this year, like you mentioned, I maybe lost 2 or 3 cookies. I'm going to be okay with that and not feel like I'm on a downward spiral.
Yeah, not panic. We don't want you to lose sleep at night, okay? Because it is going to go up and down. That's the way the stock market works. But once again, as long as we give that enough time, history has proven it will give us the best rate of return.
Okay, and so then as we get a little bit closer to retirement, let me cheat and see, this says conservative growth. So what does a conservative growth fund cookie jar mean?
Conservative growth is ultimately it's going to be less volatile, right? Now, of course, over time, you're going to get lesser return than you would over here. But as an example, let's say I'm losing 20% in that cookie jar in a year. I might only be losing 8 to 10% here. But when I'm hitting a home run over here, I'm only hitting a single or a double here.
I see.
Okay, so it's ultimately, we just don't need as much time in this cookie jar. It's just, keeping those ups and downs in check.
Right. And so then, if I were to be investing in multiple different things, should I be sort of hedging my bets with more this way when I'm younger, more this way when I'm older, or should I take all of the cookies and pour them into this jar when I get closer to retirement?
No, what you said first is exactly what we should be doing. Ultimately, just year over year as we get closer to retirement, specifically, we just want to start hedging our bets and just kind of starting to move those cookies all the way over here.
Okay.
Now, granted, I just want to make sure it's clear, we always want to have cookies there for the most part, because that's what's going to make our money last for 20, 30, if not more years.
Right.
But as we start to draw from our funds, our investments, that's why we need the cookies over here.
That makes sense. And then I see this is a very lonely looking cookie jar with only a couple of cookies. What is that fund?
So this would just be our protected growth cookie jar. So ultimately, it's whatever we would consider safe. And while being safe isn't what we would consider sexy, right? It's an absolute necessity when we're in retirement. Because as we talked over here, the market's up and down. Well, if I'm pulling from my investments, I don't want to be pulling when it's down.
Right.
I want to be pulling from my safe cookies here. Yeah, wait, when it's this full, we might as well eat them. But then eventually,
but I can't touch those cookies.
Or at least you don't want to when the market's doing really, really good, right? It's this whole adage of taking the cream off the top, right? But when the market's down, that's when it's time to deploy this cookie jar. So, for most of my clients that are pulling, this cookie jar is going to be a lot bigger,
Right.
right? But ultimately, we're going to have it appropriated across the board.
Across the board. And then I like this because there's cookies everywhere.
Yep.
And of course, cookies are money.
Exactly.
So say hypothetically I wanted to go on vacation.
Okay.
Can I take some cookies out of this jar because it's pretty full and it's doing pretty well? Or is that not a great idea because while this vacation might be fun in this moment, then my future is less secure? How does that work?
Yeah, it's a great question. In this example, and just so a quick disclosure is everyone's unique, right? So this wouldn't be advice for all of our viewers, but generally speaking, when the market's really good and you were to call me up and say, hey, I want to take a vacation for $10,000, then we would probably just take the cream off the top. Relatively speaking,
right,
this money is going to be always accessible, right?
Okay.
Relatively speaking. So if we've made some money on top of it in that year, then it's very easy to take it. Now, I don't want to say, hey, you can't take your vacation because the market's down.
Right.
That's when we would take it from here.
I see. And so we spread it around. And then are there some times when we put it in one of these funds that we absolutely cannot touch it, or if we do, there are big fees or penalties? And if that's the case, will you tell me not to eat these cookies at all?
For that reason, we were talking about like a CD, for example, right?
Right.
You would want to wait till it matures. Something that we've been leveraging a lot in our office is treasury bills, just because they're very similar to CDs, but pay a little bit higher interest rate, typically speaking.
Right.
But same concept, right? You want to wait for its maturity date before you'd pull it. So I would say, Jaclyn, why don't we wait a little bit for whatever reason? But typically we're planning for those short-term expenses,
right,
to where we would once again have a plan for it.
Right, and we would make sure that we haven't put the cookies in the cookie jar,
right,
that we've eaten those cookies,
exactly,
or we put those cookies maybe on the kitchen counter.
Exactly.
Wonderful. Well, thank you so much. This is actually so much more clear, I feel like. I have a great understanding. You're welcome anytime that you bring me cookies. Thank you for sponsoring our segment.
We love it. We love coming, so thank you so much.
If you want more information about Rooted Wealth Advisors, you can visit us on the web at ciLiving.tv, and we would be happy to connect you.